Thank you guys very much for joining me. My name is Jeremy Wagner, and I'm the lead trading instructor at DailyFX Education. Now, if you're not familiar with DailyFX, DailyFX is the research and education arm of FXCM. And so we've got a team of analysts, we've got a team of trading instructors. And so the point that I'm going to be sharing with you today is we're going to be talking about trend lines and how to time trades using trend lines. So this is a fairly, what I would consider to be cornerstone type of concept when it comes to trading Forex. So this is a great place to start if you're fairly new to trading and wanting to learn how to get started. You've definitely come to the right place. If you've been around the trading block a little while, you may find this to be a bit of a refresher for you, and that's okay because there are a couple of techniques that I'm going to share with you, and who knows what type of conversation or what type of questions may come up. Okay, let's take care of some early business here. You guys are taking a look at the risk disclaimer. I want to give you guys a moment to go ahead and read through this. So in essence, what this risk disclaimer is telling you is that what I'm about to share with you is not going to guarantee that you're going to have winning trades. And what I'm about to share with you does not guarantee that I'm going to keep you out of losing trades as well. These are just some techniques that a lot of traders use. These are very common techniques that traders will use in order to help time entries into the market. And here's another disclaimer I want to share with you as well on hypothetical performance. So we'll give you a moment to read this. And so the reason I'm sharing this particular disclaimer with you is that there are going to be a couple of hypothetical trades that I'm going to be sharing with you. They're hypothetical trades in the sense that these are trades I did not take myself. But these are, in theory, how these concepts work. These were not actual trades. They're hypothetical. Okay, so the one thing that I want you guys to be able to walk away with today is I want you to be able to gain an appreciation of what the charts, the information that the charts provide to us, can help us with regards to timing entries into trades. There's a lot of different mechanisms that we could use for timing entries, and there's a lot of different ways we could look at charts and digest numbers, but trend lines is one of the cornerstone pieces to helping time entries into the market. A lot of traders, be it newer traders or older traders or experienced traders, will use trend lines. And so I want to make this completely about this topic, so any questions that you guys have, we will certainly go through that. So we're going to start off with what trend lines are, why they're important, and then we're going to talk about how to use them in technical analysis. So starting off with what are trend lines? If you're brand new to currency trading or Forex trading, you've probably used trend lines, or you're familiar with trend, you haven't even realized it. So here we're taking a look at, let's assume you're the manager of Acme Sales, and you're taking a look at this sales chart. Well, obviously the sales have been increasing at a very steady pace, and as a matter of fact, if we just simply connect the highs of this bar chart, I get a trend line. I get a line that's pointed upward showing me that this is moving higher. Now for those that are in the business world and have maybe managed a sales firm before, will sales go on higher forever? No, it doesn't. At some point in time, sales are not going to continue at this pace. But at least for right now, this is a bit of the assumption that we're going to walk into this with. And at some point in time, we also are going to expect that these lines are going to get broken too. So when they do get broken, we're not going to want to stomp around and go kick the dog or anything like that. It's just a part of trading. So trend lines, when you see it on a chart or when you're getting ready to draw one on a chart, essentially is just a line that connects 2 points. So we're going to look at a chart, we're going to identify a common area where prices have not traded below or through, and we're going to connect that as a line on connecting those 2 points for a line. And these lines get formed, and we'll see this on a chart here in a little bit. Lines get formed through the supply of supply and demand, rather, support and resistance. So prices are an uptrend, and as the prices begin to drop, the sellers who were eager sellers at a higher price are no longer going to be as eager at this lower price. They're going to want to sell at a higher price. And then those who are buyers are going to look at this and they'll be like, hey, prices are getting cheaper. I'm going to want to buy. And so then they rush in and buy, and you have an overbalance of buyers with an underbalance of sellers. So it creates this supply and demand. It starts to create this support zone where prices just have not traded through. And so the same concept applies in a downtrend. So this is how support and resistance is formed. There's different types of support and resistance. These are horizontal levels of support and resistance. Many times when you're looking at a chart, these support and resistance levels are not going to be horizontal. It's okay if they're not horizontal. So as we can see here, I've got a green line as my floor. This is a support level. This is where, as prices drop, those who are willing sellers are seeing this become lower and lower and lower. They're no longer going to want to sell because they want to sell at a higher price. And then the buyers are looking at this thinking, all right, well, you know, I liked it at a higher level, but I even like it more at this lower level. And so you start to get a lot of buyers rushing in and pushing price up. It creates a floor, essentially, for prices. And as traders recognize where this floor exists, then what they'll do is they'll wait for prices to come down to this floor, and then they start to buy. Same applies when once you bought it and you want to sell it. In this case, I've only got 1 point up here, but you can see where prices have come up. It reached a ceiling. It could no longer reach any higher, and it bounced off that ceiling and started to drop, bounced off the floor and started pushing higher. And so as prices get up towards the red resistance line, which can act like a ceiling, prices then find this resistance. The buyers are no longer willing to buy. It's getting too expensive. Sellers are getting eager because they're like, hey, I get to sell at a much higher price. You get this imbalance of sellers over buyers. So that's a little bit about what trend lines are. Actually, those were horizontal support and resistance levels. And so why are the trend lines important? There's a couple of things that we can gain, a clue that the market is telling us by looking at trend lines. It tells us the direction of a trend. And that's important because as a trader, I want to go out and I want to trade something. Well, how do I know whether to buy or sell? A trend line answers that question for us. And then that trend line can also help us time a buy or sell into the market if prices come down to that point where people no longer are willing to sell and you have a lot of buyers willing to rush in. So here's an example. This is the New Zealand US dollar currency pair. This is a 2-hour chart, which, by the way, a lot of people ask, you know, can I apply this on a daily chart or can I apply this on a 5-minute chart? The markets are fractal, so you can do this type of technical analysis on a variety of time frames. But the larger the time frame, be it a daily, a 4-hour chart, the more stability you're going to tend to get with your signals because you have more data going into the creation of that price bar. If you use a 5-minute chart, a smaller time frame chart, you get more frequent signals, but less reliability in those signals because there's less amount of data going into the creation of that 5-minute bar versus a 4-hour bar. Okay? So New Zealand US dollar 2-hour chart, and what I've done on the chart is I've simply identified 2 low points, 2 common points on the chart. Point number 1, and then point number 2, and then I'm just drawing a line on the chart between those 2 points. And then I could tell by looking at this line, it's sloping up, so that tells me it's an uptrend. And I'm going to look to time my entry when the price comes down to touch it on the 3rd point. That's going to be my entry into the trade. Any questions so far? Yes, Isaiah. The question is there software out there that will draw these lines for you, or do you have to do them manually? And there are softwares out there that will try to create these lines on their own through an automation type of scheme. For me, the thing about a computer is that the computer is just looking at data points. It's not looking at a picture. You and I, we're looking at this, we see a picture. Now, for those that are fairly new to trading, we might have to train our eyes a little bit in order to really see the intricate details of the picture. But in essence, we're going to the art gallery and we're just seeing what this picture is trying to tell us, okay? We're trying to piece things together. A computer program, it's just looking at data points and it's using its algorithms to generate stuff, generate trading lines or trend lines. And so it's going to generate a bunch of different trend lines on a chart, and it may not draw it exactly like this. One thing to consider is that trend lines is an art and not a science. And we'll get more into that here in a moment. So yes, there are software programs that try to do it. Some of them might be effective. Some of them might not be effective. I think that you can train your eye to see it and practice it and be able to identify what's obvious on a chart, because that's what we want to look for, are those obvious trading opportunities. There's going to be a lot of trading opportunities, but if we can identify the most obvious ones, the higher probability ones, that's what I want to expend my capital on. There are some charting packages where you can draw trend lines based on the lows of the candles or the highs of the candles or the closing of the candles, and so that muddies the water a little bit. You'll notice that when I draw this trend line, I'm touching the very lowest point at point number 1. I'm touching the very lowest point of point number 2, and I'm drawing the line that way. A lot of traders run into, the mistake of they try to fit their line on the chart. They're like, okay, I think there's a line here, and then they try to make it fit, and then you have candles piercing through the line or wicks coming through the line, and it's just not a real clean chart, because remember, all this is telling us is market direction, which is obviously to the upside here, and then it's also indicating us when we could potentially time another entry into this market. And so we may draw a similar line, but when we time that entry, we may be a few pips off. So it's an art. There is no 100% answer to this. So the question is, for everybody else, is we can do this on any time frame, but how do we know what time frame to do something like this on? And that's where you're going to have to look at yourself and identify what is your trading personality. And maybe you're brand new and you have no idea what your trading personality is. That's okay as well. So some questions to answer to learn more about your trading personality is, what is my experience? If I'm an experienced trader, or am I brand new to trading Forex? If I'm fairly new to trading Forex, you're going to want to lean towards a longer time frame chart. You're going to lean towards a daily chart, lean towards a 4-hour chart. Start there. Practice on that. If you're a more experienced trader, then you can dial down to a smaller time frame chart. You can do 2 hours, 1-hour charts. If you want to get down to 5-minute charts, you can do so as well. The reason being why a more experienced trader, again, why I think that would be okay for them to dial down to a smaller time frame chart is you get more signals, more trend lines that you can draw, but you're going to get less reliable signals. And so what I would hate for is a newer trader to practice this technique on a 15-minute chart, and they're drawing trend lines all over the place, and then they're like, well, this doesn't work because the trend lines are getting broken left and right. Okay? Another question that you want to consider is, how much time do I have to trade? Or how much time do I have to learn about trading? A lot of people have a day job. That's a good thing. That's the income in order to finance your trading. So a great thing about Forex is it's a 24-hour market. So regardless of what shift you're working, you can come home and there's a market to be able to trade. And you can apply this technique on that particular market. So if you have a day job, got a wife, got kids, very busy around the home, maybe only have a couple hours a week, that's when you're going to want to lean towards a longer time frame chart. Because if you're looking at a 4-hour chart, that chart's not going to change a whole lot in 24 hours. You'll come back, it's only going to print 6 more candles. 6 more candles may not change the picture that it was telling you a little bit ago. If you have a lot of time on your hands and you want to sit in what we call become a computer jockey, trade jockey, sit in front of the computer and just watching each tick go away, well, that's, Howard, you're acting like you like to do that type of trading. That's fine as long as you have the time to do it, but it does. There are ways that you can trade the market and it doesn't require a lot of time, but it would require that you have a trade on while you're not sitting at the computer. Some people have a hard time meshing with that. There's ways that you can trade it sitting in front of the computer all day long and watching each tick go away. So this is going to be a little more advanced, all right? So the question is let's say, you notice here on the far right, I'll go over here in a minute, but notice how we have these two gray boxes, these horizontal vertical lines. Let's say that this area on the chart did not exist. We're not there yet, okay? So I have no idea that stuff exists. I'm looking at this chart, and our chart stops right about here, okay? So, and I have no idea that this stuff is printed yet. This is off into the future. So I'm looking at that chart. Where do I draw my trend line? Well, the way that somebody would draw their trend line is obviously they would probably draw it, and this would probably be 0.2 right here. Probably just bounced off of 0.2. Now, one thing that I would see, if I drew a trend line right there, then obviously it would have gotten broken probably about right here. You know, would have gotten broken near the high. So, yeah, the trend line got broken, but by the same token, you probably would have been able to knock off a trade or two. So, again, they're going to break. That will happen. We're just using this to help time an entry. Maybe we didn't catch every pip of the move. That's fine. There's no way I can time every pip of every wave. I just want to take a piece out of the market. That's all I'm looking for. An easy piece. Let me rephrase that. There's a lot of pieces of the market, but sometimes it's feeding me the pieces. All right, so here we're taking a look at the US dollar, Swiss franc. This is a daily chart. So what I've done here is I've connected lines 1 and 2. And for those of you that watch me on the live webinars, you'll notice that I like to use price channels quite a bit, a trend channel rather. And what I do with the trend channel is I will draw my line from point 1 and 2, and notice how prices came up at point 3, rubbed up very nicely against the line. Prices came at point 4, rubbed up very nicely against the line. And as it falls away from this upward slope, from this upper black line, which is a resistance line, as prices move away, it seems to stop at a same level as well. And so when I see a trend channel, a lot of times what I'll do is I'll duplicate this line. There's an easy way you can do so on the trading station. For those, you press down the control key, click on the line, and it will duplicate it for you. And I just constantly will drag this line, and I will see if it fits. So I mentioned a moment ago about trying to fit a line. This is the only line that I would recommend trying to fit. And if it doesn't fit, then get rid of it. But I'll draw this the support line. It's technically a support line, but it's downward sloping. And so therefore, if you enter into a trade at 0.3 or 0.4, well, then you know that you might want to think about exiting the trade or tightening up your stop or reducing the risk on the trade when it gets down near the bottom end of this channel, because again, the sellers may be exhausted and then the buyers may be rushing in trying to push this a bit higher. Okay, any questions? A lot of times we'll get a question of, somebody asking, okay, so if you're selling, let's say at 0.3, and then maybe you sold at 0.4, what about down here? Would you buy down here? Anybody think that? Have that question? Why not buy down here? It's a very common question. I would not recommend buying down there. Anybody want to offer up a reason why? Okay. Yeah, overall trend is down. Okay. Remember, I have downward sloping lines. The trend line tells me, because it's downward sloping, the trend is down. So as a trader, one of the questions I need to ask is, what direction do I trade this? And I'm either going to choose buy or sell. In this case, the trend line's down. I'm going to choose to sell. So if I get a buy signal, prices come down here, hit the bottom, and this is technically possibly a buy signal, I'm not going to buy, because I'm then going to be trading against this trend. There's a lot of strength behind the power of this trend. It could have been a good winning trade. That's fine, but it's not a higher probability trade. Okay, you've got a limited amount of capital, and so you want to try to identify those areas on a chart which are higher probability zones where you can put that capital to work. It might work out, it might not, but there's a higher probability chance of that working. So the higher probability zones on this chart are going to be 0.3 for a sell, 0.4 for a sell, but this is not a higher probability buy. And this really is not even a higher probability sell. either. It's a lower probability sell, and it's a low probability buy. Okay? All right, so that's a little bit of why trend lines are important. Now we're going to get more into the nitty-gritty of how to use them in technical analysis. And for those that may be fairly new to currency trading, technical analysis simply means, if you hear that term, it simply means you're looking at a chart and you're using that chart to help you identify buy and sell signals. Okay? So what we're going to look to do is we're going to draw our trend line connecting points 1 and 2. We're going to look for a third touch of that trend line. We're going to use that third touch of the trend line to help us time an entry into the trade. Another thing that I like to look for as well, I like to look for long wicks. Long wicks are hidden levels of support and resistance. Okay? So the trend lines are identifying levels of support and resistance. Long wicks is another confirmation of support and resistance. I'll get into that here in a moment and explain that. And then you could use your favorite indicator. Could be RSI, could be MACD, it could be the MICKEY indicator, doesn't matter. But use your favorite indicator and you can look for a crossover near that trend line as well when it gets to point 3. Okay, so here's an example. This is the Australian US dollar 2-hour chart. And so what I've done is I've gone through, connected points 1, connected point 2. And notice that each time it bounces off this line, it pushes higher significantly. So this is making progress to the upside. Point 3 is about to occur. Prices are drifting lower. So again, just look at the chart. Look at the story it's telling us. When it moves higher, it's on the move. When it moves back towards the line, like at point 2, look how it drifts sideways. And then it pushes higher, and then it drifts sideways. That is a beautiful picture. Almost brings a tear to my eye as a trader. The reason that's beautiful is because obviously there's an overload of buyers and the sellers just are not aggressive in this. So the trend is up and a lot of people are looking to continue buying this. Prices cannot move up higher forever. They need to consolidate, and that's what happens. It consolidates sideways, maybe even drifts lower a little bit because those who are late to the party need to get flushed out. You're late, they get flushed out, they get stopped out, but the people who got in early, they're riding on an unrealized profit the whole way along. But again, point number 3 is arriving. This one happened to work out. If somebody would have seen this and placed a trade at point number 3, all of these trades do not always work out. You will have losing trades. But let's take a look and digest what's happening here at point 3. So I've taken a zoomed in approach to these 2 orange boxes. This is the first candle. As it appears, notice how it got very close to the line, didn't quite touch it. And you know what, when you're drawing these lines, it's an art, it's not a science. And so, you know, to get so minute in the details of this is 2 pips away from my line, so it's close enough, or it's 2 pips away from my line, it's not good enough, that's too much micromanagement. Really, if it's close, it counts. But it's the wick that's going to give me the clue. So it produces a little bit of a wick to the downside. A wick simply means that prices traded down to that level, but not for very long. Prices then pushed. Buyers then push the prices back higher, and so that's why you get a wick. So again, wicks indicate hidden levels of support in this case. And it's possible that they may have been looking at this line, and they're like, hey, this is close enough to the line, and so then they start buying. Well, that happened, it got a little bit of an up push, and then it came back and retested this line again. And on this retest, it produced even a longer wick. Same size candle, but prices traded down towards this line, but not for very long. Buyers immediately pushed it higher, and therefore it left behind this long wick. So I've got 2 wicks appearing in close proximity. So the sellers, were at this time, were not aggressive, but there wasn't an aggressive amount of buyers either, and prices were just dancing around the line at this point, at point number 3. Yes, sir. Okay, the question was, so at point number 3, we're seeing this happening with the candlesticks and the trend line. At point number 3, are we going to buy when the price touches the line, or are we going to use some type of other method to confirm it? And so really it comes back to this. I like to see wicks. Wicks give me hidden clues about the market. Okay? You can also add your favorite indicator. And if your favorite indicator is starting to indicate that we're getting a rollover, that prices may start to turn higher, then there you go. That's your confirmation. If you're familiar with candlestick formations, you could look for a bullish candlestick formation, which happens to be the second candle right here. That is a bullish candlestick formation. That means that when you see a candle like this appearing near a support level, that indicates a potential bullish move, a potential up move. Yes, sir. All right, great question. So, all right, now that we've got the entry figured out, we decided we're going to hop into this trade feet first. Where are we going to place our stop? So, if you were the lucky individual that found a trade somewhere near this area, you're going to simply look to place your stop below the low of this candle. You're going to be below the black line. So, if prices trade back to that level, which is going to be, just to make it simple, let's call it the bottom of the orange box. If prices trade back down to that level, then yes, you want to be taken out of the trade because it would have broken through the black line and it would have broken through this horizontal low of the wick there. So let me do it over here for you guys. So a stop, if we entered on this first blue candle, we would look to place a stop just below the black line, maybe even where the low end of this orange box is. That's where we would look to place a stop. If prices bounce higher and then, whoops, turn tail on us, well, by that point, it would have broken through the black line. The black line is over and take me out of the trade with a loss, okay? But I'm preserving the majority of my capital. If I'm only risking a couple % on the trade, I still would have 98, 97% of my capital left over to go hunt down another trade. Profit target, what you do is you calculate that distance between your entry and where you place the stop. Look for twice that as your potential target, okay? So let's say somebody entered, this would have been maybe around the 108.25, let's call it. A stop maybe around the 107.75, so let's say it was 50 pips a stop, times 2, look for 100 pips of profit potential, and then that means you're looking at 109.25 is where you would look to take profits. That's a hypothetical example, real time. Somebody's going to place their stop a little bit tighter. Some people are going to make it a little bit wider. Again, it's that sliding scale. You place a tight stop, you're going to be more prone to get stopped out. It's going to be more prone to hit. It's kind of like playing alongside the road. The more you play alongside the road, there's a greater chance you're going to get hit. If you have a wider stop, there's a less chance that it's going to get hit, but you would be losing more capital out of your account. So it's that sliding scale. There's no perfect answer. You want to try to find that good balance. And that good balance is placing a stop just below the black line. Because again, by that time the black line's broken, kick me out of the trade. I'll take my small loss, take my toys and go to another playground. Yeah, I mean, that's a great question. So the question is, Fibonacci retracement levels and trend lines, is it a self-fulfilling prophecy? Because so many people are looking at it. Therefore, if everybody's looking at the same thing, and if they're expecting a bounce off of the trend line, then everybody's going to want to buy and nobody's going to want to sell. I agree. I think that's the case. If everybody's looking at it the same way you are, that's the kicker, is you and I could look at this chart and we could see a couple of different patterns. We're not going to draw our lines exactly at the same place, or we may not draw our Fibonacci retracement levels at the exact same place. But if it's that obvious that a lot of people are, then it can become a self-fulfilling prophecy. And then again, if you happen to be on the second red candle, stop would be just below this low, which would be below the black line. And then twice that distance to your stop would be your take profit level. All right, this is one that got away. So let me show you how this, in my opinion, was a great setup, but it ended up being a losing trade. So you could have a great setup, in my opinion, and then it could not work out for you. And that's why it's important that you want to risk a small portion of your account. Because if we go in like, oh man, I love this setup, I'm going to throw down a lot of capital on this, they still can turn out to be losing trades, even though everything works out. Looks to be a good setup in your favor. So let's just go ahead and digest this a little bit. Oops, pound Aussie. And this is a 4-hour chart. Pound Aussie has been in a very powerful trend to the downside. I've got a very nice downward sloping black line. and a very powerful trend because you've got the Australian dollar mixed in with this currency pair. A lot of people are chasing after the Australian dollar because it has a higher yielding currency and they're able to make daily interest on it. And so by selling this pair, that means that they are earning the interest in their account and holding it beyond 5 p.m. New York time. So I draw my lines at point 1 and point 2, starting to set up my resistance zone, and I'm awaiting point 3. Okay? Now, as point 3 approaches, I notice on my chart that previously prices came down, it found some support at this dotted purple line. Found some support, it bounced higher, it created point 2, and then it broke through this purple dotted line. So even though it broke through this purple dotted line, and it doesn't mean that that purple dotted line is no longer useful. I'm just going to use it in a different manner. And since it broke through, it was support, it broke through, now it's going to become, or has the potential to become, new resistance. And so when I see a confluence of resistance in this situation, I've got a downward sloping black line, I've got a horizontal purple line, which I drew at the low of this candle right here. They are all coming together, and prices is acting like it's want to join. It's all convening and converging at the same zone. So I'm starting to get excited about this. I'm getting excited about this because I have two different levels of resistance coming together. Why is that important to me? Well, let's say I gave you a hammer and I asked you to go beat a hole in the wall. You could do it. You could probably give that hammer to your kids. Your kids could do it. Okay? You have the hammer. Very useful tool for that. Now, let's take this same hammer. Let's go to a corner where you have two walls coming together. Now try to beat a hole in that wall. It's going to be a bit tougher, isn't it? You might still be able to do it, but it's just going to be tougher. It's going to require more energy and more effort. And then imagine a point in your house or your apartment where maybe you have three walls coming together at the same point. Now try to beat a hole into that. You might still be able to do it, but it's even going to require more effort. So when I see a setup where I've got a converging resistance levels coming together in a downtrend, or if I have converging support levels coming together in an uptrend, I'm starting to get excited because I've got two walls coming together, and although prices can push through it like it did in this example, then it tends to be a bit stronger than what we would normally see with just a straight black line. The other thing that's happening at this zone is I also have this red dotted line. And as prices broke through my purple line, it then came up and it found some resistance near this red dotted line. And this red dotted line is very close to this purple line. And so I've kind of have two levels of resistance between the red and the purple. It's all converging in the same area where my black line is coming together. And price is acting like it's wanting to meet at this zone. And so I'm getting excited about this and wanting to make this trade. I'm starting to get this wick. This is a zoomed in portion of the orange area down below. I get a wick to the upside and it happens to get very close to those lines. So I think, hey, this is it. Let's go ahead and hop into it. Hop into it, place your stop. In this case, I would probably place a stop just up above the purple line because remember, that was one of the resistance lines that was coming into play here. So I would probably place a stop just up above this purple line, which this is an inset of this orange box down here. And prices, got a little bit of a bounce, but then eventually, would have gone up and pierced that stop. So, that's all right because at that point, my analysis is negated. Those two walls, that person effectively came through and they were able to beat a hole in that wall. Okay, that's fine. Take me out of the trade. I'll take my couple of percentage loss on it and I'm going to go take my toys to another playground, look for another trading opportunity. Question is could I get maybe, this candle here, maybe it wicks out, takes me out of the trade and then it ends up moving in my direction where I wanted to go? Yeah, happens frequently. It's part of trading. You'll have some losing trades. But again, what you're saying is, take me out of the trade if it moves beyond this level. And you end up with a losing trade. Hopefully you risked a small portion of your account. You still have 97, 98% left over. Go find another trading opportunity. I have a rule in my trading, my personal trading, and because of that situation, that is, that is an emotion that can be very difficult to manage, and that is you get stopped out of a trade only to see prices go where you thought or where you wanted it to go, and you're like, oh, man, I thought I did everything right, wonderful setup, market wicked me out. That's a very challenging emotion because you want to get back at it. And so I have a rule. This is a rule I apply to my personal trading to help combat that, because yeah, it still bothers me too. Even though I've lost 1 or 2% out of my account, it's the fact that I was that close to a winner, and it wears on you a little bit. So the rule that I have is once I have a losing trade, doesn't matter what currency pair, what the setup was, what strategy I'm using, I don't trade it for a day. I don't go back. So I see it move in that direction, and sometimes you're compelled to want to chase after it. My rule is I don't trade it for a day. And if I come back a day later and I'm still hurting about it, well, then I'm going to give myself another 24-hour cooling off period. I'm going to go look. So if I feel so compelled that I have to make a trade, I'm going to go find another currency pair to trade. I don't want the pound Aussie to bite me again. I'm going to go find something else. And if that something else bites me, well, then I'll start to forget about the pound Aussie. And so, yes, playing breakouts of trend lines is a viable way to trade. Now, we're talking about two opposite styles of trading. Trading a trend line this way versus trading a breakout of a trend line. They are opposite. There is no way around it. I'm not going to sugarcoat it for you. They are opposite. As much as male versus female, as much as black versus white, they are opposite. So, how do we know when to do a bounce like this? How do we know when to do a breakout like this gentleman was asking about? And the answer to that question depends on the trend. Where's my trend going? Is my trend down? Okay, I'm going to look for sell trades. Now I'm going to go out and I'm going to look for technical reasons to enter a sell trade. I see this trend line. Okay, great. So then that's going to be my entry into this. Now, but if I wanted to play a breakout using trend lines, here's what I would do. Assuming I've cooled off from this loss, I would draw a trend line going upwards connecting these lows. Because once that breaks, then that would be that confirmation that it's ready to start possibly heading lower. Assuming the trend is still down. Absolutely. It's a great question. Swiss yen. So here we've added the indicator to the chart. Again, we've drawn points 1 and 2. We're getting a test on point 3. Also, I'm getting a cross up on my slow stochastics indicator here as well. And so that could be my additional confirmation. I'm got a nice wick approaching near the line. So I've got a lot of things matching up on this trade. So a nice wick to the downside, hitting the line. Got my cross up, my buy signal on stochastics. My trends to the upside, Swiss yen. Two safe haven currencies matched together. This is the pound Swiss. This thing's been in a monster trend to the downside until the Swiss National Bank decided to intervene in the market and try to put a lid on Swiss franc appreciation. So I had a nice trend channel. I started off by drawing my downward sloping resistance line, point 1, point 2, and then I duplicated this as a trend channel. So I look for that entry at point 3, happens to coincide with my turn down on my indicator as well. So even if I don't get my wicks, I can still use the indicator when it crosses down to be the case. Point 4, same thing. Actually poked up a little bit higher. This indicates to me this trend is running out of some gas, because before this was a very clean trend line. Now we got a little bit of a poke up above. And then also, the more times that a line gets tested, the weaker it becomes. So that's why I talk about entering on the third touch. The third touch there's benefits, there's detriments to the third touch. The benefit is you're catching that trend line early. The downside to it is maybe that's not the best trend line because you're just picking 2 points. And that may not be the best 2 points on the chart. So that is the downside to using it. But once you start getting 4 and 5 and 6 touches, then everybody's starting to notice it, and then it starts to lose its luster a little bit because it's like waves on the beach. It just keeps wearing out that beach, and eventually it starts to erode. So here's another trade that we got stopped out on. Now I had a slow stochastics as my indicator on the other chart. This time I'm using RSI. I don't want you to think that stochastics is better than RSI or RSI is worse than stochastics. I could have thrown RSI on the other chart. It would have given you a very similar signal. I could throw stochastics on this chart. It's going to give you a very similar signal. But here's a situation where RSI came up. It touched my 70 zone. I'm in a downtrend on the Euro Swiss. Prices are near that resistance line. And depending on where my stop was and my take profit level, yeah, maybe this trade might have worked out depending on this little dip lower. But the chances are probably would have gotten stopped out on that trade. All right, we're getting here. Just got a couple more slides. We'll take some more questions. The dollar yen, definitely want to talk about this because the folks over in Japan that work for the finance minister, the Bank of Japan, I think they need to attend our courses because they are intervening in this dollar yen exchange rate and they are not affecting the trend at all. They are, in my opinion, if they're wanting to intervene, they need to break through some of these support or resistance levels. So here we're taking a look at a 4-hour chart. This was back in April, late March, April of this year. And we can see this orange box on the far left-hand side. That was right after the earthquake in Japan. The tsunami came. And then the yen appreciated, meaning this exchange rate was dropping. And at that point, the yen was reaching all-time highs in value. And so, of course, Japan was coming out. They don't want a strong currency. They intervened in the market, pushed these rates up higher, and actually we did get a pretty good jolt higher out of that. Now I've got this MACD indicator at the bottom of my chart. This is just another indicator that you could add to your chart. And so we could use that to be our timing mechanism. I draw points 1, point 2. Lo and behold, back in, I forget what day that was late July, early August here, just about 30, 45 days ago, they came out, intervened in the market again. Well, guess what? All they did was push it up to our resistance zone. If you're a trend trader, you're just sitting there, you're waiting for prices to come up to your black line, and here's what they did. They pushed it right up to the black line. People saw this, and they started selling it. They gave them a great opportunity to sell. Immediately, prices come right back. So, I mean, that intervention was completely wasted. So, in my opinion, what the Bank of Japan needs to do, if they're going to intervene in the market, they need to blow the doors off the barn, and they need to scream this thing higher than these support and resistance levels, or in this case, resistance levels that traders are watching. And so, again, on this point number 3, for we time our entry, we could use the MACD as our signal to go ahead and enter into that trade. Place our stop just up above the swing high. This chart, I wanted to illustrate that point of how Bank of Japan, they've intervened several times in the last year, and how their intervention really has done nothing to the exchange rate. This is a daily chart going back to May of 2010, and this is a pretty current chart. It's about 30 days old. Goes through August, about 30 days ago. So if I connect points 1 and point 2, I draw my blue resistance line. Well, back in September of last year, about a year ago, Bank of Japan, all right, the yen's getting too strong, we got to go intervene. They go out, they intervene, and they push prices back higher. This is the Bank of Japan intervention, this orange box. Well, again, what did they do? They just push it up to a resistance level. Traders are coming in, they start selling it again, selling the pair, buying Japanese yen, and then it continued to fall. So another instance where they completely wasted, the opportunity. They would have been better off doing nothing. So again, my opinion, if they want to intervene, they need to push this higher than that blue line. And then this was the chart I was talking about earlier. Push it higher in the black line. Get some of these people starting to look bullish, look for long trades, then looking at these resistance lines as areas to sell into. So we've got a lot of resources on support and resistance trend lines. So if you're interested in more, I can email you some links to some videos we have. We'll do some live webinars on support and resistance and drawn trend lines in real market environments as well. So how many folks have a live account here in this room? FXCM, live account FXCM? Okay, maybe half or so. Well, you guys have access to our live webinars. And I've got a webinar that I do at 9 a.m. Eastern Time. So for those on the West Coast, that's 6 a.m. Eastern time, and so we do a lot of support and resistance in there, so I certainly would invite you out. It's available inside Daily FX Plus. Your live FXCM account grants you access to it. It's completely free, no charge for you, and that's every day at 9 a.m. Eastern. So feel free to email me if you would like some of these resources. You can copy this down. You can grab my card up front. You're more than welcome to do so. So thank you guys very much.